Have you ever wondered how an index fund, which aims to mirror an entire market, actually achieves that incredible feat? It seems almost magical how they keep up with thousands of stocks or commodities, all moving at different speeds. Index funds primarily use three main strategies for replication: full replication, sampling, and synthetic replication. These methods allow them to track the performance of a specific market index as closely as possible, ensuring your investment broadly follows the market. The choice of strategy depends on several key factors, including the number of assets in the index, their liquidity, and the cost of managing the fund. Full replication, for instance, involves buying every single asset in the index in the exact same proportion. This is ideal for indexes with a relatively small number of highly liquid components, aiming for the lowest possible tracking error, which is the difference between the fund's performance and the index's performance. However, for indexes with hundreds or even thousands of securities, or those with illiquid assets like many commodities, full replication becomes too expensive and complex to execute efficiently. This is where sampling comes in, involving the selection of a representative subset of the index's assets that closely mirrors the overall index's risk and return characteristics in a cost-effective way. Lastly, synthetic replication, often used by certain exchange-traded funds, does not buy the underlying assets directly. Instead, it uses financial derivatives like swaps to achieve the index's return, which can be very efficient but introduces counterparty risk. As an investor, you can usually find detailed information about an index fund's specific replication strategy within its prospectus or official fact sheet. Understanding these different approaches helps you gauge the potential for tracking error and how closely your fund is likely to mirror the performance of the index it intends to follow. When a fund uses sampling, it might employ techniques like stratified sampling, where assets are grouped by factors such as market capitalization or sector before selection, to ensure an even better representation of the entire index. This careful selection process helps maintain the fund's accuracy even without owning every single asset. Knowing how an index fund replicates its target index empowers you to make more informed investment decisions, ensuring you choose funds that align with your expectations for market tracking and risk, ultimately helping you protect your financial future.